Harsha Upadhyaya is with us, Chief Investment Officer at Kotak Mahindra Asset Management Company. Harsha, great to have you with us here. Thanks very much for joining us. It's been this week was and actually the end of the previous week and the beginning of the first few days of this week just looked very painful and gripped by fear. Of course, I mean, as we end this week, it's looking a lot better. But is it going to remain a little better relative? It's all relative. Or you think we are still not out of the woods and there will be these bouts of severe selling? What's your sense?
Good morning, Prashant. See, as far as market is concerned, it seems to be more of the same. The volatility has continued into 2026. We are in the middle of the earnings season. Earnings season is expected to throw up a decent recovery compared to first half, in our opinion. It will not be very, very significant uptick, but definitely there will be signs of improvement in terms of earnings trajectory, at least for the large caps and certain mid caps in our view. That should help markets to take some support at lower levels. However, when you look at international news, that's not been great. Every few days we have been hearing some negative or the other. So to that extent, given the fact that valuations are still at around long-term averages, and the fact that earnings are still at the nascent stages of recovery, we are likely to see a similar kind of market movements over the next few months as well.
Harsha, where do you stand in realty? It's been such a tough beginning to 2026. The index is down 10%. Individual stocks are down so much more. What is the call you all had on real estate? And now, given the underperformance from last year and now, including 2026 so far, would you have a relook at real estate?
Rima, we have been underweight on real estate sector for quite some time now, and that has worked out quite nicely. As you mentioned, it has been a relative underperformer to benchmark until now, at least for the last 5 to 6 quarters. Now that we've seen significant correction, probably one can look at selectively betting on certain real estate names. However, one should also remember that probably we are in the 6th year of upcycle in the real estate market in India. So to that extent, we would be taking a little bit of risk in terms of a continuation of that cycle. Historically, the cycle has continued for 8 to 10 years. So definitely we are past the halfway mark in terms of the upcycle in real estate. So I don't think at this point of time we would take a very, very large top-down view on the sector. Rather, we would look to invest selectively if the correction continues.
Hi, Harsha. Good morning and good to see you. And Harsha, the last couple of weeks, people have actually got even more fearful. Earlier, at least, there was that bravado that was playing out. How do you see things play out? If someone who's looking at allocating money, what would you tell them? That bulk of the bad news is in the price? Or do you think that still things are very, very skittish, both on the domestic as well as on the global front? And we've already fired quite a few bullets, both from the center as well as from the RBI. So what would your advice be? Bulk of the bad news in the price? Or is this still turning out to be a very, very uncertain couple of months?
Nigel, if you look at markets from September 24 onwards, it's been either declining or sideways for most of the period. So to that extent, I think time-wise consolidation has happened. If you look at the valuations, the large cap valuations are almost at long-term averages. If you look at mid caps, while it is slightly higher, the expected earnings growth is also likely to be slightly better than large caps. The real risk, however, still continues to be in small caps, which we have been highlighting for more than a year now. The valuations are almost 40 to 45% premium to long-term averages when you look at the index valuations. Over the last 5 or 6 quarters, there have been at least 2 or 3 quarters where the small cap earnings have actually declined. Forget about the expectations of 20-25% growth. They have not even given positive earnings growth. It's been a decline. So to that extent, the valuation risk in small caps is still very, very high. And in this quarter as well, we are unlikely to see any significant pickup in small caps vis-a-vis large and mid caps in terms of earnings trajectory. So to that extent, I would say that while markets have consolidated well, it's better to be in large and mid caps. Depending on your risk profile, you could choose a different proportion of large and mid, but it's still better to be in large and mid rather than focusing on small caps at this point of time.
Harsha, budgets in the past, if you look at the last 10 plus years, they've marked a decisive shift. Earlier it was capital goods, defense, etc., and the kind of spending. And that decided the way capital allocation was done, which were the outperforming sectors. Then there was a marked shift towards consumption, boost to rural as well as urban consumption. In this budget, do you expect any sort of a turn which can dictate the way money needs to be allocated?
It doesn't seem like, Reema. If you look at nominal GDP growth expectations, they are likely to be somewhere in that a double-digit band, early double digits. So given that and the fact that the government is going to keep an eye on fiscal deficit, and probably we are going to see a 10 to 15 basis points of lower fiscal deficit number for the next year, and the likely fact that possibly you will also have a glide path towards a lower debt to GDP numbers, etc. It's very difficult to assume that there will be very large capital expenditure plans from the central government. In an absolute way, yes, it will still be a very large number, but on a year-on-year basis, you are likely to see maybe early double-digit kind of growth. And most of this is going to go into some of the sectors such as defense, renewables, manufacturing, and all of that. So it's likely to be more of the same in terms of the policy push, in our opinion. And of course, consumption has got some structural benefit through lower GST numbers. And even without anything specifically in the budget, that should continue to get some boost.
Harsha, just 2 questions. One, what are you telling investors, distributors, etc., with regards to what people should do with gold and silver ETFs? Right, that is one. And the other is, ICICI Pru AMC recently, actually they started accepting lump sum into their small cap fund starting today, with effect from today. Across industry, you included, right? I think you were one of the first to stop inflows, March of 24, I believe. So any rethink? I know you just said valuation discomfort and maybe large caps are better, but just your thoughts there.
Prashant, on your first question about gold and silver, we continue to remain positive on both of these asset classes. However, one should keep a prudent asset allocation in mind when you are looking at any of the asset classes, and especially the asset classes which have done so well over the last 12 months. For example, gold is probably up 70-80% over the last year. Silver is up almost 3 times in a span of about 6 or 7 months. So to that extent, anything which has moved in a vertical fashion, in a parabolic fashion, is likely to see volatility even without any fundamental reasons. So to that extent, any aggressive investment at this point of time comes with a lot of risk. However, given what's happening in terms of global trade and commerce, in terms of geopolitics, in terms of world order in general, we do believe that precious metals will continue to see a reasonable uptick. However, one needs to have a reasonably long-term outlook and also needs to make staggered investments rather than jumping in the fear of missing out. I think that's the biggest issue that one has to contend with at this point of time. As far as small caps are concerned, clearly our view remains that they are quite expensive. We are not stopping subscription of our small cap funds. However, we are clearly communicating to our investors and partners that probably it's better to be in large and mid caps in different proportions depending on the risk profile at this point of time, rather than taking focused small cap exposure. However, even when you take diversified exposure, you are likely to get 5-10% kind of exposure to small caps, which will be more of bottom-up selective opportunities that the portfolio managers would bet on. And that's sufficient enough to take an exposure to small cap at this point of time, in our view.
Harsha, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV 18.